Welcome to the deep. Exactly. So by the end of this deep dive, you should have the crucial knowledge you need to hopefully navigate this pretty multifaceted market with more confidence.
It's a truly fascinating time. The diamond market, like a lot of luxury sectors, has really been on quite a journey recently.
Roller coaster is absolutely the right word. What I found genuinely surprising, actually, in our research was that diamonds were a top-performing purchase during the pandemic.
Yeah, that caught some people off guard.
People were stuck at home, maybe had extra savings from not traveling or eating out, and they bought diamonds. Lots of them. It almost feels counterintuitive, doesn't it?
It does, a bit. But what's fascinating, like you said, is that this unexpected boom actually led to a saturated demand later on.
Okay. So the pendulum swung back.
Pretty hard. As economies reopened, suppliers found themselves left with this surplus of investment-grade diamonds. Demand just couldn't keep up with that sudden glut of supply.
Right.
And then on top of that, you had rising inflation hitting the U.S., which is a critical diamond market, remember?
Mm-hmm.
About half the global market.
Exactly. And then you also had that property market collapse over in China, another huge player. Both those factors together, they took a significant toll.
And the numbers, well, they really paint a vivid picture of that downturn, don't they?
They certainly do. The value of wholesale polished diamonds dropped by a staggering 20% in 2023.
20%, wow.
And it was even more dramatic for rough or uncut diamonds. They plummeted by as much as 35%.
35.
Yeah.
This really forced industry giants like De Beers to make some big moves. They significantly cut their prices in early 2025, anywhere between, say, 10% and 25%.
And it wasn't just De Beers reacting, was it? We saw Alrosa, the big Russian miner.
Alrosa.
They actually canceled sales entirely for a couple of months late in 2023.
October and November sales were off the table.
Which was a pretty clear move to restrict supply, wasn't it? Trying to stabilize things.
Absolutely. A classic supply management tactic. It really highlights how actively the industry itself works to manage demand during these sorts of fluctuations.
So after hearing all that, the drops, the canceled sales, you might be thinking, is it all doom and gloom for diamond investors? What's the real outlook for 2025?
Not necessarily doom and gloom, no. While the immediate outlook for 2025 certainly holds some uncertainty, there are actually compelling reasons for hope.
Okay, that's good to hear.
I mean, the diamond industry isn't just some niche market, it's a behemoth. It's valued at over $100 billion globally.
That's huge.
And experts are projecting market growth maybe 3% to 4.5% annually, which could see it reach nearly $130 billion by 2030.
So underlying growth is still expected.
Yes. And despite the recent difficulties, the Rappaport Diamond Price List, which is, a key global benchmark for polished diamond prices.
Like RapNet.
Exactly. It actually suggested that 2023 finished quite strong, largely thanks to the holiday season.
Okay, so demand didn't just vanish.
Precisely. It indicates that a clear underlying demand is still very much present. But, and here's the crucial insight for you listening, it's not all diamonds that appreciate significantly. Only specific diamonds tend to really increase in value over the long term.
Right. Not the diamond necklace you bought at the mall, necessarily.
Generally not, no. We're talking about the ultra-rare ones. Think natural, fancy-colored diamonds, reds, blues, pinks. Extremely rare stuff.
Okay.
And for colorless diamonds, the standard white ones, they need truly outstanding characteristics.
Yeah.
Top-tier cut, significant weight, exceptional clarity. That's what makes them strong investment pieces.
Okay, that makes sense. So selectivity is key. Let's unpack this a bit more then. What are the big factors really affecting diamond investment right now as we move through 2025?
Well, the first major factor is definitely the ongoing impact of Russian sanctions on global supply chains.
Right, they're still playing out.
Very much so. Sanctions on Russian diamond exports combined with a tightening of the Kimberley Process Certification Scheme.
Which is the system to prevent conflict diamonds, right?
Exactly. It certifies the origin. Those two things together are definitely restricting the overall supply of diamonds hitting the market.
How big of an impact does Russia have?
It's huge. Russia alone accounts for about one-third of the world's diamond production. And Alrosa, the company we mentioned, is responsible for about 28% of global supply on its own.
Wow. Okay.
And the restrictions placed on Russia's payment systems, things like being cut off from SWIFT, have really crippled trade. It makes it incredibly difficult for buyers in other nations to actually settle transactions.
So the diamonds might be there, but you can't easily buy them.
In many cases, yes. And this situation, logically, could bump up prices due to genuine supply shortages, particularly once the existing reserves, the diamonds already outside Russia start to run out.
And public opinion plays a role, too.
Definitely. We've also seen public pressure leading some major jewelry brands and retailers to sever ties completely with Russian suppliers, further tightening that market.
That's a massive disruption then. But there's another really fascinating trend our research highlighted, the rise of lab-grown diamonds.
The synthetics.
It seems many millennials, for instance, are really embracing synthetic or lab-grown diamonds. They now make up, what, about 17% of the market?
Around that, yes. And growing fast.
And some projections are suggesting they could account for 50% of loose diamonds sold by American jewelers from 2025 onwards. I mean, that sounds like a dramatic shift.
It is indeed a significant market trend, no doubt about it. And it's certainly impacting the, let's say, the broader retail diamond landscape.
I sense a but coming.
But, yes. It's critical to provide context here, especially for investors. While they're popular and often more affordable, lab-grown diamonds simply lack the geological history, the billions of years of formation.
But romance, maybe.
The romance, the cultural significance, the tradition, and crucially, the inherent rarity of natural diamonds.
Okay.
So as such, their growing presence is actually highly unlikely to disrupt the premium end of the natural diamond investment market. They serve a different purpose, really, for a different segment of the consumer base.
So the key takeaway for you, our listeners, maybe think of lab-growns more like a consumer product.
Right.
While natural rare diamonds are the true investment asset class.
That's a good way to put it. They occupy different spaces.
Okay. So beyond these specific industry factors, sanctions, lab-growns, what about the broader economic picture? You know, we're seeing inflation hopefully coming down, interest rates maybe stabilizing, and some of those gloomy recession predictions for 2025 are actually being revised. How does that play into the diamond market?
Absolutely. Global economic growth, or lack thereof, plays a huge role in the luxury market overall.
Makes sense.
And there are three critical economies that diamond investors really must keep a close eye on. We mentioned the U.S. already around 50% of global sales.
Right.
But also China and India. Huge growing markets for diamonds. Renewed economic growth and, importantly, consumer confidence in these regions could significantly benefit diamond investors. It could potentially offset any sort of continued softness we might still see in the U.S. market, for instance.
So strength in Asia could balance things out.
Potentially, yes. It's a global picture.
And finally, there's this idea you mentioned earlier, price instability, and that strategic supply control within the industry itself. It seems the big players are actively, holding back supply to try and strengthen demand. And rough diamond production still hasn't hit pre-pandemic levels.
Correct. This raises an important question, though, for market stability going forward. If demand does pick up properly after a relatively weak 2023, what happens to all those diamonds that have been stockpiled by miners or dealers?
They could flood the market.
Potentially. Hesitant sellers might see 2025 as the opportunity they've been waiting for to offload that inventory. And that sudden influx could temporarily destabilize the market, at least for the more common types of stones.
Okay, so more volatility possible even with recovery.
It's possible. And this really reinforces our earlier point. For solid, reliable, long-term returns, focusing on ultra-rare or high-quality, naturally colored diamonds might be the clearest path forward for now. They tend to be less susceptible to these broader market fluctuations and sudden dumps of supply.
Their rarity protects them, essentially.
To a large degree, yes.
Okay, so if you are looking to invest, perhaps focusing on that higher end, how do you even begin to value a diamond? We often hear about the 4 C's, but our research kept emphasizing the 5 C's as the real foundation.
That's right. The 5th C is crucial for investment, so let's break them down. Carat, cut, color, clarity, and the all-important certificate.
Let's start with carat. That's just the weight, right?
It refers to the weight, yes. 1 carat equals 200 milligrams. Simple enough. But here's where it gets really interesting from a value perspective. The human element, you could call it. Psychology. It creates these sudden, quite significant price surges at specific sort of magic weights.
Like?
Think 0.3 carats, 0.5, 0.7. But especially 1.00 carat. A diamond that weighs exactly 1.00 carat could be worth as much as 20% more than an otherwise identical diamond weighing 0.99 carats.
Just for that tiny hundredth of a carat.
Purely due to perception. The ability to say it's a full 1 carat diamond holds immense psychological value in the market. It's fascinating.
That is fascinating. So that tiny difference means a big price jump. Wild. What about cut?
Okay, cut. This one is unique because it's the only one of the Cs that is influenced solely by human skill and artistry. It's not about the rough stone itself, but how it's faceted.
Ah, the craftsmanship.
Precisely. The cut dictates how light interacts with the diamond, how it enters, bounces around, and exits. This affects its fire, the flashes of color, its brightness, the white light reflected, and its scintillation, that incredible sparkle and life we associate with diamonds.
And there are different styles of cut.
Many common cuts, yes. You've got the classic round brilliant, the marquise emerald cut, princess cut. Each one is expertly designed to maximize these optical properties, but in slightly different ways, creating different looks.
Got it. Then there's color. Now, I always thought completely colorless was the absolute best, but you said earlier that's not always the case for investment, right?
Exactly. For colorless diamonds, the standard white ones, yes, the less color, the better generally. The GIA scale.
That's the Gemological Institute of America.
Correct. The global authority in diamond grading. Their scale goes from D, which is the absolute top grade, completely colorless and most valuable, all the way down to Z, which has a noticeable light yellow or brown tint. So for colorless stones, D, E, and F grades are typically most coveted and valuable. But, and this is absolutely crucial for investment potential naturally colored diamonds.
The fancy colors.
Yes, the fancy colors like reds, blues, pinks, even intense yellows or blacks.
Yeah.
These are generally far, far more valuable than even a top D colorless diamond, simply due to their extreme rarity and unique beauty. Nature doesn't make many of them.
So rarity trumps lack of color there.
In a big way. Just one word of warning. Be wary of any diamonds advertised with the color in inverted commas, like blue in quotes.
How's that?
That typically indicates it's a treated diamond, maybe irradiated or coated to enhance its color. These treated stones hold significantly less investment value than naturally colored ones. Authenticity is paramount.
Good tip. Okay, next up, clarity. What does that tell us?
Clarity refers to the presence or absence of internal flaws, which are called inclusions.
Like little marks inside the stone.
Exactly, and also external blemishes on the surface. The GIA clarity scale ranges from flawless, FL, which means absolutely no inclusions or blemishes visible even under 10x magnification.
Perfect, basically.
Pretty much. All the way down through VVS, very, very slightly included, VS, very slightly included, SI, slightly included, to I included, with grades 1, 2, and 3 with in included.
So flawless is the target for investment.
It's ideal for colorless stones, yes. But interestingly, clarity is often considered less critical for naturally colored diamonds.
Why is that?
Because their value is driven so much by the rarity and intensity of their color. A few minor inclusions might be overlooked if the color is exceptional. The color is the star.
Okay, that makes sense. And finally, the fifth C, which you mentioned earlier, is perhaps the most crucial for investment: certificate.
Absolutely. I can't stress this enough. For any serious diamond investment, a reputable certificate is non-negotiable, especially if you ever plan to sell it and get the best price.
It's the proof, essentially.
It's undeniable, independent proof of a diamond's authentic quality and all its characteristics it sees. The GIA certification system, for example, is globally recognized and known for being incredibly strict, consistent, and reliable.
Are there other reputable labs?
Yes. Others like AGS or IGI are also well regarded, but GIA is often seen as the gold standard, particularly for investment-grade stones.
And you mentioned laser inscriptions.
Right. To take security a step further, many certified diamonds now have their certificate number micro-laser inscribed onto the girdle, the thin edge of the diamond.
Wow.
This offers undeniable proof linking the physical diamond to its paper certificate, adding significant value and security that, a loose paper certificate alone might not. It prevents fraud.
Okay, so those are the foundational 5 Cs, essential stuff. But our research suggested there's even more to consider beyond them, especially for jewelry pieces. What else should our listeners be looking for?
Definitely. Beyond the core 5 Cs, several other factors can dramatically affect the value, particularly of a finished piece of jewelry. The manufacturer or designer is a huge one.
The brand name.
Exactly. Prestigious names like Cartier, Tiffany's, Graff, Van Cleef & Arpels, Harry Winston. These can significantly add investment value, especially for rare pieces that are in great condition.
Why is that? Just the name recognition.
Partly, yes, but also because these top houses historically sourced and set only the absolute finest quality stones using exceptional craftsmanship. So there's an inherent premium associated with their work.
That makes sense. A brand name guarantees a certain level of quality. What about the story behind a piece? Does that matter?
Oh, absolutely. That ties directly into provenance. This is essentially the history, the ownership trail of a piece.
Like where it came from.
Precisely. Where was it made? Where was it originally purchased? Do you have any original paperwork, receipts, old valuation documents? Or perhaps there's a strong, verifiable story attached to its original owner. All of this can dramatically increase its value.
So a bit like fine art provenance.
Very similar concept. For instance, finding specific French hallmarks like a tiny eagle's head for gold or a dog's head for platinum can indicate high-quality craftsmanship from a desirable origin and period, adding historical significance and value. It's like a hidden language for collectors and investors.
Fascinating. And what about the age and era of a piece? Are older diamonds always better investments?
Not always better, but age and era definitely command a different kind of value and appeal. Jewelry typically falls into three broad categories. You have antique, pieces over 100 years old. These usually predate mass production techniques, so they're often unique, incredibly skillfully handcrafted, and can hold very high value. Think eras like Victorian, Georgian, Edwardian, Art Deco, or Belle Epoque.
Okay. Then there's vintage.
Vintage jewelry is typically between, say, 20 or 30 years old, up to 100 years. Many vintage pieces were mass-produced, especially from the mid-20th century onwards, but specific styles or designers can still be highly collectible.
And estate.
Estate is really just an umbrella term for any previously owned jewelry, regardless of age. Often it refers to pieces from the last 30 years or so, but technically, antique and vintage pieces are also estate jewelry once they're pre-owned.
Are there specific older eras that are particularly hot for investment right now?
From an investment perspective, two eras consistently stand out. Art Deco, which is roughly 1914 to 1935.
And for geometric designs, right?
Exactly. Strong geometric aesthetics, often using platinum, inspired by Cubism, very bold designs, and also Belle Epoque, roughly 1870 to 1914. Think intricate, delicate, lacy designs in gold and platinum, often featuring many small diamonds.
And these periods offer good returns.
Our research indicates that high-quality, well-preserved pieces from these specific eras have seen really significant returns, sometimes appreciating by as much as 80 or 90% over a few decades.
Wow. Okay. What about just the basic condition?
Condition is absolutely paramount. It probably has the single most substantial impact on the investment price of any pre-owned piece. Even minor damage can significantly devalue it.
So check for chips, scratches, loose settings.
All of that. Professional cleaning is absolutely vital before you get any valuation done. But be cautious sometimes. Just mild soap and warm water with a soft brush is sufficient. Harsh chemicals can potentially damage certain stones or metal settings.
Good point. And let's not forget the metal quality itself. The setting isn't just there to hold the diamond.
Not at all. The purity, the carat of the gold, or if it's platinum and the sheer weight of the precious metal, definitely contribute to the overall value of the piece, sometimes quite significantly.
Right, it all adds up.
Exactly. Which leads to the final point here. While doing your own homework using these guidelines is really useful, consulting a qualified independent specialist valuer is honestly the only guaranteed way to truly know a diamond or a piece of jewelry's potential investment value.
They see things we don't.
They have the trained eye, the equipment, the market knowledge. They can spot those subtle, almost hidden signs of quality, origin, or condition that the untrained eye would almost certainly miss. Getting a professional appraisal is really an investment in itself.
Okay, solid advice. Now this brings us to a really compelling question that came up. Can you actually wear your investment? With fine jewelry, it seems the answer is yes.
It can be, yes. Fine jewelry, when you select it wisely, absolutely tends to appreciate in value over time. It can be both beautiful and a good store of value.
But there's a catch, isn't there? Especially regarding where you buy it.
A major caveat here, yes. For investment purposes, you generally want to avoid buying brand new from typical high street retailers.
Why is that? The markup.
Exactly. They often have retail markups exceeding 100%, sometimes much more, plus you might pay VAT or sales tax on top. This means a piece you buy today for, say, £200 might only have a resale or scrap value of maybe £50 or £60 tomorrow. The immediate depreciation is huge.
So where should you look for investment jewelry?
Investment-grade pieces should really be sought secondhand from reputable estate dealers, or particularly at auctions. That's where you're more likely to buy closer to the intrinsic or market value.
And you mentioned designer marks earlier.
Yes, another fascinating aspect. The collectability of specific designer marks or signatures, often hidden very discreetly inside a ring shank or on the back of a clasp.
Like a little secret code?
Kind of. Once these marks are identified and verified by an expert, they can sometimes double or even treble a piece's value compared to an unmarked equivalent. It's like finding a hidden signature of quality, rarity, and desirability.
Okay, so diamonds and fine jewelry are one avenue. What about diversifying beyond just diamonds? We looked into the broader gemstone market too.
Right. That market is significant, though smaller than diamonds. About half the size, maybe $53 billion per year globally.
But the growth rate looked interesting.
Yes, that's the key point. It boasts a stronger projected CAGR, that's compound annual growth rate. Meaning its projected growth rate year over year is estimated at an impressive 6%. That's actually higher than the projected growth for diamonds overall.
Interesting. So what kind of stones are we talking about here?
Well, there's a whole world of exciting options for you to consider. Think rubies, emeralds, sapphires, also things like fine opals, tourmalines, alexandrites.
Are they good investments?
They generally offer stable value and tend to increase steadily, often keeping pace with or slightly exceeding inflation. But like diamonds, they are typically long-term investments, not for quick flips.
Right. Patience is key.
What's particularly fascinating here is how the gemstone market serves different needs. It's valuable for businesses, dealers who often buy rough stones at lower prices, have them cut and sell them on. And it's valuable for consumers, offering rarity, incredible aesthetic value, status symbols, and importantly, their value often seems less susceptible to those really broad economic fluctuations compared to, say, standard consumer goods.
They hold value differently.
Right.
Let's touch on a few specific popular gemstones. What about sapphires?
Sapphires are a fantastic example. Most people think of blue, and you certainly have wonderful varieties like the deep, rich, royal blue Ceylon sapphires from Sri Lanka or the vibrant Australian blue sapphires.
But aren't there other colors?
Oh, yes. Some of the most highly coveted sapphires come from Kashmir, Burma, Myanmar, and Sri Lanka, known for their intense color and clarity. But you can also find beautiful and popular pink sapphires, yellow ones, and even the rare and valuable pinkish-orange variety known as Padparaja sapphire.
Are they durable for jewelry?
Very durable. They rate a 9 on the Mohs hardness scale. Remember, diamond is a 10, the hardest. So sapphires are excellent for everyday wear and jewelry.
Okay. What about rubies, the red gems?
Right. For rubies, the general rule of thumb is the deeper and more vivid the red color, the greater the value. Think pigeon blood red, which is the most prized hue historically associated with stones from Myanmar.
Anything else unique about them?
Some rubies contain unique needle-like inclusions, rutile inclusions that can create a star effect called asterism when cut correctly as a cabochon. These star rubies are highly prized.
And fakes are an issue.
Like with many valuable gems, yes. Lab-grown rubies are common and look very similar. So getting guarantees of quality and, crucially, origin from a reputable source or lab report is absolutely paramount if you're considering ruby for investment.
Makes sense. And emeralds, known for their green color.
Exactly. Famous for their bright, verdant green hues. Interestingly, unlike diamonds where clarity is king, inclusions are often accepted, even expected in emeralds. They're sometimes poetically called the jardin, or garden, within the stone.
So flaws are okay.
Minor ones, yes, they give the stone character. In fact, emeralds are very commonly treated with oils to enhance their apparent clarity and fill tiny surface-reaching fractures. This is a standard and accepted practice, but should always be disclosed.
And the cut, is there a specific one?
Yes, the classic rectangular or square step cut with beveled corners is so strongly associated with this gem that it's actually called the emerald cut. It's designed specifically to maximize the stone's beautiful color while protecting its corners, as emeralds are a bit more brittle than rubies or sapphires.
Right, about 7.5 to 8 on the Mohs scale.
Precisely. Needs a bit more care in setting and wearing.
Okay, this is all sounding really promising: diamonds, other gems, fine jewelry. But how do we invest strategically? What are the truly wise purchasing strategies? And just as importantly, what pitfalls should we definitely try to avoid?
Good questions. We found some great advice from experts like David Sonnenthal, who's from New Bond Street Pawnbrokers in London, a highly respected figure in the trade.
Okay, what is he advise?
His key advice is always try to buy as close to the current market price or even wholesale price as possible. Avoid those huge retail markups we talked about.
Makes sense.
He even suggests that purchasing at, say, 25% to 30% over the current market value can still potentially make for a viable long-term asset, assuming the quality is there. But obviously, aiming lower is better if you can manage it, perhaps through auctions or private sales.
And prioritize quality, always.
Absolutely. Prioritize quality above all else for investment. For example, remember Rappaport, that global pricing benchmark? Investment-grade diamonds that are generally accepted for trading on platforms like RapNet must typically meet pretty strict criteria. Generally, that means a clarity grade of at least VS2.
Which was very slightly included.
Right. Meaning any imperfections are minor and difficult to see without magnification, and a color grade of at least H, which is in the near colorless range. And of course, as we stressed before, GIA certification is pretty much essential at this level.
That's excellent, really actionable advice there. So a key takeaway here for you listening is definitely don't rush into diamond or gemstone investing without doing thorough research. It's really not about just buying any pretty stone.
Exactly right. And just as important are the things to actively avoid. First, and perhaps most obviously, paying too much.
Falling for the sparkle without checking the price.
Precisely. Always do your market research, compare prices, consult trusted, independent specialists, and make sure you're getting fair value. Don't let emotion alone drive the purchase.
Good discipline to have. What else?
Second critical point. Don't expect instant returns. Diamonds and high-quality gemstones can be a fantastic way to diversify a long-term investment portfolio, and they can offer security and a hedge against inflation, but they are absolutely not a get-rich-quick scheme. You won't likely double your money next year. Patience is crucial here. Think in terms of years or even decades for significant appreciation.
The long game.
It's a long game. And finally, related to the first point, avoid buying the wrong diamond or gem.
Meaning one that doesn't fit investment criteria.
Exactly. This loops us right back to our detailed discussion of the 5 C's: provenance, condition, designer, era, and so on. You really need to consider all those factors carefully.
And get advice.
And get specialist advice to ensure the specific diamond or piece of jewelry aligns with your actual investment goals. You know, taking a risk on maybe quirkier, trendier pieces might offer sudden spikes in value if you catch a wave.
But it's riskier.
Much riskier. It's generally the classic, high-quality, well-certified, and often rarer pieces that offer that better long-term stability and more consistent appreciation potential.
Got it. Focus on quality, be patient, don't overpay, and do your homework.
That sums it up pretty well.
Okay. So to kind of recap everything we've dug into today, diamonds, other precious gems, find jewelry when you approach it with savvy research, due diligence, and importantly, patience. They really can be a wonderful, tangible, and relatively safe investment class, even beyond 2025.
They can offer impressive returns for those investors who really understand the nuances of the market.
It's a tangible asset, something you can see and touch that can appreciate beautifully over time, unlike, say, just numbers on a screen.
Which brings us maybe to a final thought. If we connect all this to the sort of bigger picture, in a world that feels like it has increasing political and social uncertainty, what does the enduring stability, the portability, and the tangible beauty of these precious stones and metals truly represent for the future of investment?
That's interesting. A store of value outside the system, almost.
Perhaps. They are a store of value, certainly, but maybe they're also something more. A testament, perhaps, to enduring human craftsmanship, natural wonder, aspiration, maybe even enduring beauty itself in uncertain times.
It's a powerful thought to leave our listeners with, isn't it? Perhaps thinking about these factors, rarity, beauty, history, tangibility, might change how you perceive value, not just in gemstones, but maybe in other tangible assets you might consider for your own future.
Food for thought, definitely.
Well, we certainly hope this deep dive has provided you with a clarity, pun intended, to potentially shine brightly in your future investment decisions. Thanks for joining us.